Hi, Scott Senner here with Interlinc Mortgage Cabinet Financing. And today we're going to be talking about the items on your credit report that factor into your debt to income ratio. Some of these are pretty obvious, some are not. So kind of listen up and start making your own notes. So first of all, the things that do factor into your debt to income ratio, obviously your mortgage payment, car payment. On credit cards, we only care about the minimum required payment. We don't care at all about the balance or what you actually pay every month. So in other words, I might see American Express cards with a balance of $5,000 with a minimum payment of $400 a month, and then the same borrower has a Capital One card with a 200 or a $2,000 balance with a minimum payment of 50 bucks. So each creditor is different regarding the minimum required payment. That's the only number we care about. We also have to count student loans, whether or not they're in deferment. And this is one that can trip up a lot of people. If your loan's in deferment or whether you're making payments, it doesn't make any difference. If you're making payments, we have to count the required minimum payment that's on your credit report. If it's in deferment, we have to take the balance times 0.5% to come up with a qualifying payment. So if you have $50,000 in student loans, half a percent of that is 250. So we have to count $250 a month against your debt to income ratio, even if that student loan's in deferment. It stinks, but that's just the way that the calculations work, and there's nothing we can do about it right now. We also are required to count child support payments and alimony payments against your debt to income ratio. Some items that do not count towards debt to income ratio, we do not have to count any child care expenses like daycare or anything like that. We also don't have to count school tuition payments if your kids go to private school. We don't have to count utility payments. We don't have to count any insurance payments like car insurance, renter's insurance, or anything like that. On the flip side of that, we do have to count insurance and tax payments that are on your primary residence or on rental property that may not be escrowed. So if you have a $2,000 a month house payment and in addition to that you pay annually your insurance and taxes, we have to take that annual amount of insurance and taxes, divide by 12, and that's what we have to use for your qualifying payment towards your debt to income ratio. As always, if you have any questions about how this works or would like us to run some calculations for you, please don't hesitate to reach out. Have a fantastic day, and we'll catch you next week. Bye.